Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 29th, 2025. I hope you are doing well. I hope you had a nice Thanksgiving last week. I hope you had a good trading week, and I hope you are having a really nice weekend at this moment. I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful. I'm going to share with you some good things today, I hope, and I hope you are going to learn a lot. So, the format today for the podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I entered last week, all the trades that I exited last week, and we're going to talk about when I bought them, why I bought them, what the signals were, what the confluences of signals happening at the same time were of why I entered the trade. We're going to talk about how I position sized my initial entry based upon the volatility of the market and therefore how many shares I was going to buy or that I bought. We're going to talk about where I place my emergency stop, where I place my end of bar stop, how I take partial profits if the market moves in my direction, how I'm going to go into trailing stop mode, and then ultimately how I am going to exit the trade. So I had a really good week last week. I hope you did as well, but I'll show you all these trades, explain to you when I entered, why I entered, and how I'm going to manage the positions going forward. After that, we are going to talk about trader psychology, spend a few minutes on it. It is the most important skill, everybody, the skill of being able to create a plan and then follow the plan. You can have the best trading plan in the world with all sorts of edges, but if you don't follow it, what good is it, right? So it always comes down to trader psychology. So it's always helpful for me to teach trader psychology for my own trading, and so I hope that it's going to be helpful for you as well. After that, I did go down through my master watch list last night. I do it every Friday night, and I look for some potential trades for the next week, for the upcoming week. Now, what I'm going to show you, they are not where they need to be, but if they get to where I want them to be, then I will consider taking the trade. I like to look for confluences of many things happening at the same time. If I'm going to go long, I'm looking for multiple support levels, whether those are order blocks, whether those are major moving averages, whether those are low RSI readings, whether they're double bottom bullish MACD divergences, or ideally, many of those things happening together. The more signals that you can get happening at the same time, really what this means is that there are many different groups of buyers buying. Like, for example, an order block. Okay, there's order block traders. If it rejects an order block, they're going to get in. And then there are deep dip buy traders or major moving average traders. If it rejects a moving average, they'll get in. If you have an under 30, over 30, different type of trader, they enter there. But if all those things are happening at the same time, then essentially you have three different groups of buyers coming in at the same time. And if you put yourself in a position, if we're talking about going long, where there are many different groups at the same time going long, you have a much better chance. You're in good company, right? You're in good long company, so you have a much better chance of having a profitable trade. So this is what I look for. I look for, essentially, in another way to say it, I look for different groups of buyers buying at the same time. And so I have identified 7 different potential trades for next week where there are confluences happening. They're not there yet. If they were, I probably would have already taken the trade, but they're in the ballpark. They're getting close to potentially happening. And so I'll share those with you. I hope that is going to be helpful for you. I've got a lot of emails lately from people letting me know that, boy, those really work out. And they do. More times than not. Not all the time, right? But more times than not. You just have to be patient and wait for them. But patience usually pays off in the market. So if you find anything that's helpful today in this podcast as we go along, I really would appreciate it if you could hit the thumbs up button. It helps the channel, lets YouTube know that there's some valuable content here so they can share it with more people. If you haven't subscribed, I would really appreciate if you could do that as well. So that is the format for today. And let's first of all run this U.S. legal disclaimer, get this out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get rolling. Let's go through the current positions that I have at the moment. Let's start off with USO. USO is oil. I bought USO here on October 20th at 67.81. So you can see it's done quite well. But why did I buy it? Well, you see the green box we have here. This is what is considered an order block. And an order block, if you get a signal where you go in the order block and then close above it, that is called a rejection of the order block. Sometimes that is a legitimate signal. Also, if you go below it and close back in it, that could also be a legitimate signal. So you can see we did reject the high of the order block by going in it and closing above it, and I got long at 67.81. So let's first talk about what an order block is. Okay, an order block is going to be, if you see this green box here, if you go in the past, the order block happened in the past. I just brought the order block into the future. So let's go into the past and take a look at where the order block started. Okay, let me see this so you guys can see it a little bit better. Okay, this is the order block. On 5/30/2025, this is the order block. The high and the low at this bar is the order block. And you can see I highlight the high and the low and I bring it into the future. So, but what makes this an order block? So an order block has a certain pattern that has to be fulfilled in order for it to be a legitimate order block. It starts with a swing low. This is a swing low. A swing low has a higher low to the left and it has a higher low to the right. Would you agree? The bar to the left has a low that's higher than the middle bar, and the order block, and the bar to the right has a higher low than the middle bar. So this is called a swing low. First of all, we need a swing low. Then we need a swing high. A swing high is just the opposite. It has a lower high to the left and a lower high to the right, right? So far we have a swing low, we have a swing high. Now the next thing we need is we need another swing low that's lower than the first swing low. Well, this is a swing low. Higher low to the left, higher low to the right. So now we have the basics of what we need to look for an order block. We need a swing low, a swing high, a lower swing low. Okay, once we have that in place, we need to look back to the swing high. Remember how we have that swing high? Swing low, swing high, lower swing low. We need to look at the swing high. Now, when you have a swing low, a swing high, a lower swing low, and then after that, the market goes up above that swing high, now we have changed market structure to the upside. So one more time, if you have a swing low, followed by a swing high, followed by a lower swing low, and then we take out or we go above that swing high, now market structure has changed. And you can see as soon as that happened, boy, it really changed, didn't it, right? But the way that I trade this is when the market structure changes, now I know where the order block is. The order block is the lowest closing bar prior to market structure change. So swing low, swing high, lower, swing low, market structure change. As soon as it changes market structure to the upside, I just go to the left, find the lowest closing bar before the market structure change, and I've identified the order block, the high and the low, and I bring it into the future. Now, you can see when we change market structure and the market just took off up here, is it fair to say when it's up here that smart money was buying down here? Pretty clear to me that smart money clearly was buying here, right? In hindsight, when you're up here and you look back here, smart money was buying here. So the idea with order blocks is that what was once smart money, if we bring this smart money level into the future, if you come back to that smart money area, the idea is more times than not, it is going again to be smart money. Not always, doesn't have to be. So when I get a swing low, swing high, lower swing low, market structure change to the upside, I identify the smart money area, the high and the low, the lowest closing bar before market structure change. This is my smart money area. And then I need to wait for the market to come back again to the smart money area. Okay, so that is an order block. So let's go here where I bought. Now it kind of makes more sense. This was the smart money area. Now we come back. The trigger to get into the trade is it rejected the high of the order block. So that's why I entered at 67.81. Now, when I find an entry, and this is an order block entry, the first thing I need to do if I see a legitimate entry is I need to decide how many shares I'm going to buy. Okay, so it's a very simple formula I use. It's based upon how much money I have in my trading account and this number here. The average true range 2 equals 290. This is just essentially the 2 ATR value. This is going to change every day, but those are the only two things I need. So let's just start off and let's say I have $100,000, okay, in my trading account. All I do is I take 1% of that $100,000, which is 1,000, right? If I have 200,000, 1%'s 2. If I have a million, 1%'s 10. If I have 50,000, 1%'s 500, right? So it's very simple. So just $100,000, 1% is $1,000. Okay. After I have this number, I look to what the value of the 2 ATR is. It's 290. This measures volatility. When there's more volatility, this number will be higher. When this number's higher and I divide it into this number, it will tell me to buy fewer shares. If this number's lower, when I divide it into $1,000 in this example, it'll tell me to buy more shares. So essentially what it does is when volatility is higher, it just automatically has you buy fewer number of shares, which is the correct thing to do. If volatility is higher, you should adjust your position to have fewer shares, okay? So 1% of 100,000 is $1,000 divided by the value of the 2 ATR, which right now is 290. It would tell me to buy 344.8 shares. So I would just round that up to 355 shares. So now this is the correct amount based on the way that I trade. This is the correct amount of shares to buy based upon my account value and the market volatility. Okay, so I jump in here. I have my entry. I get long at 67.81. Now, as soon as I get long, I look back to this number, 290. I take my entry price minus 290 and I place my line here. This is my emergency stop. My emergency stop is exactly 2 ATRs below my entry. If I have 345 shares and it goes down $2.90 to my emergency stop, how much have I lost? $1,000. I've lost 1%, right? That is all that I want to risk on this trade. If I'm wrong, there's got to be a point to where I say, that's it, I'm done. It hit my emergency stop. I lost 1% of my account. Losing 1% of your account is not fun, but you can recover from it. But the good news is that this getting to your emergency stop only happens about 5% of the time in my experience. The other 95% of the time, if I have a loss, it's going to be less than 1%, sometimes much less than 1%. And this is called my end of bar stop. So I always have two stops, emergency stop, end of bar stop. On this particular trade, my end of bar stop is simply a close below the low of this order block. If I bought it here and the very next day it closed even 1 penny below that order block, I would simply get out. Would I have lost 1%? No, probably 0.5%, right? Because my emergency stop down here, I would only lose 1%. But the key is I like to enter trades where I'm as close to my end of bar stop as possible, giving me the best risk to reward ratio. Okay? Okay, so I got in because it rejected the high of the order block. That's the reason for the entry, 67.81. I position size, like I just showed you, place my emergency stop 2 ATRs below. On this trade, it's my end of bar stop is a close below the low of the order block, the low of the order block 66.03, and I take the trade. All right. Now, the next thing I do, I need to look here to the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $2.18. So as soon as I enter and I know where my emergency stop is, I know where my end of bar stop is, I take my entry price plus the value of the 218, the value of the 1.5 ATR, which is 218, and I place an orange line above, 1.5 ATRs above my entry. So why do I do that? Well, if it moves 1.5 ATRs in my direction, it's doing pretty well. And at that point, in trading in general, when you start to move up significantly, you want to tighten up everything. You want to tighten up the stops in your trade. You don't want to give it all back, right? And that's exactly why I go into trailing stop mode. So I enter the position. I place my 1.5 trailing stop level 1.5 ATRs above, which is right now it's 218. If it gets there, it doesn't mean I do anything. All that it means is now I am in trailing stop mode, which means that now in the future, if I have a close below a previous bar's low, I'm going to exit half of the remaining shares that I have. Exiting half, what does that do? Well, that just by default, that brings everything up. It tightens everything up because I've reduced my position size by half. So my stops are much closer, right? I mean, they're at the same level, but I have fewer shares, so it tightens everything up by half. Okay. So, and I'll go through this as I go through the details of the trade. So everything I've talked about so far, as far as the emergency stops, the end of bar stops, going into trailing stop mode, these are defensive moves. So in other words, if the market goes against me, I need to take action. But I don't want to just play defense in my trading. I also want to play offense, just like any good sports team you have. You can have great defense, but if you have a bad offense, you're not going to win many games either, right? You need to have the balance. So the way that I play offense in my trading is that I take partial positions off each day if it moves a certain amount from the previous bar's close. So I'm in this trade. Let me give you an example. It's very simple. All I do is I look at the closing price. So USO, the closing price is 71.07, right? Very simple. I take the closing price, 71.07, and now I look for the value of the 0.45 ATR. The 0.45 ATR value is 65 cents. So I take the closing price, 71.07 plus 65 cents. My first profit target for Monday is 71.72. If it gets to 71.72 on Monday, I will sell 10% of however many shares I went into the day with. If I went into the day with 100 shares and it gets to 70.72, I sell 10 shares. That's it. But I always place 3 profit targets. First profit target, the close, plus the value of the 0.65, 71.72. And I do it again. all I do is I start with 71.72, my first profit target, add 65 cents to it. My second profit target is 72.37. If it gets to the first profit target, 71.72, now it gets to 72.37. All I do is I sell another, if I went into the shares into the day with 100 shares, another 10 at that second profit target. Then I do it one more time. I take the second profit target plus the 0.45 ATR, 73.02. So going into Monday, I will have 3 profit targets. First profit target, second profit target, third profit target. If it moves up and I hit 3 profit targets, how many shares will I take off? Well, if I went into the day with 100, I sell 10, 10, and 10, right? If I hit 2 profit targets, I sell 20 shares. If I hit 1 profit target, I sell 10 shares. If it goes down and I don't hit any profit targets, well, I don't take any profit targets. But profit targets to me in my trading are very important. Again, it's the offensive nature and the defensive nature of trading. I have my defense in place. End of emergency stop, end of bar stop, trailing stop, defensive, taking partial profits by selling a portion of my position into strength, offensive. Okay? All right, so those are the basics. And so let's follow this trade and see what happened. All right. Again, I entered here on the 20th of October at 67.81. It's rejection of the high of the order block. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the order block. It's 66.03. I place my 1.5 ATR trailing stop level above, and away we go. The next day, boom, right off the bat, went my way, right? Grateful for that. And I believe I hit 2 profit targets that day. So already I'm reducing my position size, locking in those gains. Next day, up again, big, hit multiple profit targets on this day. In addition to hitting the multiple profit targets, I also got to trailing stop low because I got to the orange line. Now, I don't do anything. All it means now is I'm in trailing stop mode, which means in the future, if I have a close below previous bar's low, I'm going to get out of half of the remaining shares that I have. Next day, up again, really big. I think I hit 3 profit targets on this day. Did not close below previous bar's low, so I do nothing other than take the partial profits. Next day, up a little bit, not enough for a profit target. Next day, down a little bit, but didn't close below the previous bar's low. Next day, we go down. We have our first close below a previous bar's low. After reaching trailing stop level, what do? I sell half of the remaining shares that I have, and that's exactly what I did for a gain of 4.97%. Then we kind of moved sideways here for a couple weeks. There were a couple days where I hit a profit target, then it went down, and then we had a little rally back up here. I took another profit target or 2 into that strength. Then we went down, and then another profit target here, another profit target here. Again, taking it while the market gave it to me, and then we moved down pretty substantially. But I'm still above my order block, the bottom of my order block, so I take the position. If the market goes up like it does here, took a profit target. Next day down, no profit targets. And then you can see Wednesday was up, profit target. Friday was up, profit target. So as it's dancing around here, when it moves up enough for me to take a profit target, fine. And I'll just continue to do that as long as it stays above my stop. All right. So at the moment, the remaining shares that I have on USO doing pretty well, up 4.59%. And again, this was a rejection of the high of the order block, and it's worked out quite well so far. MO, which is Altria. Okay, well, you see the green box, so that means part of the reason that I entered this trade was based upon a rejection of an order block. This time, I entered on November 3rd at 56.60. 63. Okay, why did I enter? Because during the day it went below the order block and then closed back above the order block. That's it. So I entered. I placed my emergency stop 2 ATRs below as always. Oops, sorry. My end of bar stop is simply a close below this green box. You see how close we are to it already? Again, that's a good risk to reward ratio. If the next day it had closed below, I simply would have got out for a very small loss, right? So rejection of the bottom of the order block, I position size, place the emergency stop 2 ATRs below. I place my trailing stop level 1.5 above, as always. The next day, took off, profit target. Great. Next day, up again, near the high of the day, another profit target. Next day, sideways, didn't do anything. Next day, up, profit target, reducing, reducing, reducing. Next day, nothing. The next day went up, profit target, and I also got to trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a bar closing below a previous bar's low, after now that I'm in trailing stop mode, I'm going to exit half. This happened here on the 13th. First close below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares for a gain of 2.02%. Okay, sold half, but I still have half. That's one of the best things in trading is selling half. If you sell half and it goes down the next day, you are glad you sold half. If you sell half and it goes up the next day, you're still glad you have half. It's about the only win-win in trading that there is. Okay, next day, up, profit target. Next day, nothing. Next day, up multiple profit targets into that string. And then down here, profit target. Then we had a big day down, but again, we're still above the low of the order block. So I hang in there and continue to take profit targets if they're given to me. Next day, profit target. Next day, profit target. And then Friday was up, but not enough for a profit target. So the remaining shares that I have on this particular trade doing quite well, up 4.05%. So the key is here, as long as it stays above the stop, hang in there, take profits when you have them. Now, if we move up high enough, if we get to a 65 RSI level, then I have other rules that come into play. If I get to 65 RSI level and then we close below the 5 EMA, completely out of the trade. If we go up to the 70 RSI level, reject the 70, I sell half of the remaining shares. After that happens, if I have a close below previous bar's low, then I'm completely out of the trade. But I have some other examples today where we're in that range that I'll show you, because there's a certain point where you just need to exit the trade, not just because of a stop loss, just because it has moved far enough in your direction. But again, this was an order block trade or a smart money trade that I took with a very good risk to reward ratio, and the remaining shares up 4.05%. So nice trade there. TMC, this was a monster, everyone. Really, really glad for this. Now, technically, this was only a rejection of the 200-day moving average because you see the order block in here. And let me give you kind of a big picture here on TMC. We started an order block all the way back here, June 2nd. Swing low, swing high, lower, swing low, market structure change. Again, when the price was up here and you look back to the order block, is it fair to say that smart money was buying here? I would say so. It almost doubled. So this is the smart money area. Bring that smart money in area into the future. And in the future, if you come back to it, doesn't always have to be smart money again, but many times it is. Look what happened here. I didn't buy it here, but we broke structure to the upside. We came back to the smart money area. Was that smart money? Did it hold? Yes, it certainly did. The stock almost tripled and then sold all the way off. But this time I was ready for it. And I said, listen, if we come down back to the smart money area, I'm going to consider buying. Well, the black line is the 200-day moving average. Now, if you reject the 200-day moving average, which means that you either close under it and close back over, that is a rejection of the 200, or you bounce, like where I entered, it just bounced and closed above it, or it went below it during the day and then closed above it. That's called an intraday rejection. Those are all considered rejections of the 200. Now, a rejection of the 200 or the 250 or the 300, these are all legitimate entries by themselves. But as I mentioned at the beginning of the podcast, I'm looking for confluences, right? Ideally, I want to see a 200-day moving average inside the order block. It doubles the chances of me having a profitable trade because I have a major moving average, which by itself is legitimate with a rejection inside of an order block, which is also a smart money area. So I bought here on the 17th. It did not reject the high of the order block, but big picture, it's kind of near the smart money area. But the legitimate entry for me was a rejection of the 200-day moving average. I entered at 488. I position size correctly. My emergency stop, as always, 2 ATRs below. My end of bar stop on this trade is simply a close below the black line. You see how close I am to the black line anyway? So the next day, had it closed below the bottom, had it closed below the 200-day moving average, I simply would have been out. That's the key, a good risk to reward, okay? So I put my 1.5 ATR stop at 1.5 ATR trailing stop level above, and away we go. The next day, up big, right off the bat. With respect to that 200, buyers came in up, multiple profit targets. Next day, gapped up high, multiple profit targets into that gap. Also, now in trailing stop mode. Okay, doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. That's what happened on the 20th. It was the first close below the previous bar's low after reaching trailing stop level. I took off half the shares that I had for a gain of 6.72%. But the key is I kept half, right? Next day down, but I stayed in the trade because it closed over the 200. Next day up a little, next day up a little. Wednesday up massive, where I hit multiple profit targets. And then look at Friday, up 19.38% on Friday. I hit 5 profit targets on this day. So we are currently at 60.86 on the RSI. As I just mentioned, if we get to a 65 RSI level, now this little blue line, the 5 EMA, will come into play. If I have a close below that, I'll simply exit the entire trade. So the remaining shares on this particular trade up 29.89%. And, you know, if you've been watching this podcast, I've been talking about TMC for a while. I didn't get involved up here. I said, look, I'm waiting. I'm being patient for it to come down to the 200 and or the smart money area. And I waited and I waited and I waited and I waited until it triggered. And now the remaining shares up 29.89. Big trade. Really grateful for that. It's really nice. Shopify. All right. I bought Shopify on the 18th of November at 140.47. There was an order block. It rejected the high of the order block. So I entered, I position sized, I placed my emergency stop 2 ATRs below. My end of bar stop is a close below. Actually, on this one, it was a close below this halfway line. See the green line inside? So what's that about? Well, if sometimes you can have these tall order blocks, and if there's a tall order block, meaning, you know, the bottom's down here and the order block's way up here, I'm not going to use a close below the low of the order block because the risk to reward ratio is not good. So when I find an order block, I go to the left and I try to find something. Oh, sorry. I try to find something based upon my experience that I can key off of. Well, the order block started here on 9/2/2025. So I marked the halfway of this bar. Why? Well, because this particular bar was a strong up bar. If you have a strong up bar from a Fibonacci standpoint, halfway of that up bar, there will be support, inherent Fibonacci support. Doesn't have to be, but more times than not, there is. So I have this big up bar. I know that halfway of this bar will have some inherent support. So that's why I drew the green line in the middle of this up bar. So I bring this all back to the future now. It's pretty amazing, isn't it? On the day that it made its low, months and months and months and months later, where did it bounce exactly? At the line that I picked from months and months ago. That's exactly where it bounced. Isn't that amazing? So on this particular trade, yes, it rejected the high of the order block. It also rejected the midpoint that I put there, right? So I position size, I placed my emergency stop 2 ATRs below. My end of bar stop on this trade was not a close below the low of the order block, but a close below the low of this midpoint at 136 even, okay? So it gives me a better risk to reward ratio because that stop is closer to my entry. Okay, I placed my 1.5 ATR trailing stop level above as normal. Next day it goes up right away, perfect, multiple profit targets. Next day gaps opened big, hit multiple profit targets, and on this particular day it also got to trailing stop mode. Okay, I don't do anything, it's just that now I'm in trailing stop mode. The next day down, but it did not close below the previous bar's low. Next day up, profit target. Next day up, no. Last few days, no profit targets, but it's stayed up. But so I am in trailing stop mode. So if Monday we close below Friday's low, I would take off half the position. So the remaining shares that I have here on this particular trade, doing quite well, up 11.59%. FXY. FXY is the Japanese yen. Not a lot of people trade this, but I do follow it. And this has been a great trade. I bought FXY on 11/20/25 at 58.33. Why? Well, you see the green box, that's an order block. That's a smart money area. Remember, if we reject the high of the order block, that's potentially legitimate, depending on the height of the order block. If we reject the low of the order block, I tend to always take those, not always, but if everything lines up, the low of the order block, there's not a lot of, if it's a good risk to reward ratio and it's the low of the order block, generally I'll take it, is what I'm saying, right? So I entered here 58.33, a position size, placed my emergency stop 2 ATRs below. My end of bar stop, guys, it's just simply a close below the order block. I'm very close to it anyway, right? Again, risk to reward. Placed my 1.5 ATR trailing stop level above. Next day, boom, takes right off. Multiple profit targets, immediately puts me into trailing stop mode. The next day's down, no profit targets. The next day's up, profit targets. And then here on Wednesday, we had our first close below a previous bar's low after reaching trailing stop level. What do? I take off half the position. I took off half the position for a gain of 0.80%, which doesn't sound like a lot, but on a currency, that's quite a lot. And then on Friday, I hit another profit target. Sorry, I know this other profit target is kind of getting in the way here. But on Friday, went up, took another profit target. So the remaining shares that I have now, oh, there we go, on FXY up 1.02%. But look at that. That rejection of that order block or that smart money area, nailed it. Just nailed it. You need to learn about order blocks. You need to learn about smart money areas. It'll change your trading life, I promise you. MasterCard. All right. You see another green box? It's an order block. This time I entered on 11/19/2025 at 5:30:38. Why? Simple. Rejection of the bottom of the order block. So I got long here. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the order block. Next day went down. Did I get out? No, because it closed inside the order block. Okay. Oh, placed my 1.5 ATRs above as well. So the next day hit a profit target right off the bat, but then it closed lower, but it kept me in. Next day up big, multiple profit targets. Next day sideways, nothing. Next day up, profit target, and I got to trailing stop level. So I am in trailing stop level at the moment. And then Friday, one more profit target. You can see the 0.45 is 436. It went up 561. So I certainly hit one profit target, right? So the remaining shares, I am in trailing stop mode. But the remaining shares I have on MasterCard up 3.65%. Microsoft. All right. You see the green box. That's an order block from the past. I entered long Microsoft 11/21/25 at 472.10 because it went below the low of the order block and then it closed in the order block. This is about the best risk to reward ratio you could ever have. So I position size, I placed my emergency stop 2 ATRs below. My end of bar stops a close below the lower of the order block. You can see the next day, during the day, it went below, but I don't care about that unless it hits my emergency stop. All I care about is how it closes. Did it close in the order block? Yes, it did. It kept me in the trade. The next day, again, tried to go below the order block during the day, but yet closed above the order block, keeping me in the trade. Next day, up. Okay, profit target. Perfect. Next day, Friday, up. Profit target. And I'm also at trailing stop level. So the remaining shares that I have on Microsoft doing quite well, up 4.13%. And again, based upon the rejection of the bottom of the order block. T-Mobile. All right. Well, you see the green box. Green box is an order block. Okay. I entered here on the 24th of November at $206.87. Why? Because it rejected the bottom of the order block. I entered, position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this order block. Next day was down, but it stayed in the order block. Next day was up a little. Next day up again, and I hit a profit target into that strength, took it off. Also had a dividend in here, which is nice because now in 15, 20 days or whatever, I'll get $1 dividend on however many shares I went into that day with as well, right? So this particular trade, yes, it's up. The remaining shares that I have are up 1.03%, but I still have a dividend coming. So it makes this higher as well. Makes sense? So not to trailing stop level yet. All I'm doing is keying off the bottom of this order block. As long as it stays above, I'll stay in there, take partial profits. If it gets to trailing stop mode, then I'll go in trailing stop mode and use those rules. If we get up to a 65 RSI, then the 5 EMA will come into play. And if it does get to 65 or higher and close below the 5 EMA, I'm out. If it rejects the 70 RSI, I'm going to exit half the remaining shares. And then after rejecting the 70 RSI in the future, if I have a close below a previous bar's low, end of the trade, right? These are all the rules that I use for my trading. I've been trading for over 30 years, and I use these rules, every single rule. There's a purpose for this, and this is what I use, right? This is what I use. This is what I teach my students. And, later in the podcast, I'll talk a little bit about this, but I do teach a 20-hour one-on-one course where I teach you all these rules. I teach people from all over the world, and I've turned out some really, really great traders using these approaches. So if you're interested, stand by, and later in the podcast, I'll talk about it. So the remaining shares on TMUS up 1.03%. LMT, Lockheed Martin. Okay, this is an order block, but you see how I have the green line inside of the order block? Well, let's go back and figure out why I put that line there. Okay, so it's a little bit more complicated, but let's start with the order block. Here's the swing low. Here's the swing high. Here's our lower swing low. And here we change market structure. Okay. Now, clearly after market structure change, it went way up. Again, we'll play this game. When you see the market trading at this high here, and you know where the order block was here, is it safe to say that smart money was buying here before this big run? Yeah, obviously, right? So now I know this is a smart money area. This is the order block. It's the lowest closing bar before market structure change. I'm not going to chase this, but based upon the premise that this is smart money, in the future, if we come back to smart money area, I just know more often than not, previous smart money is smart money again. Not always, but more times than not. Now, let's talk about this green line in the middle. Why did I write this here? Because these three bars are what is called a V2. The V2 consists of three bars, bar 1, bar 2, bar 3. Bar 2 has to go below the low of bar 1's low. Bar 3 has to close above the close of bar 1. Do we have that? Excuse me, we do. Bar 1, bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Why is that important? It's important because when you have a V2, the washout bar, which is the second bar, we call it the washout bar because it goes below the first bar's low. Halfway of that washout bar, there is going to be inherent support. So that's why I picked the halfway of this washout bar, this V2, as my line in the sand going forward. Again, it's an important level inside of an important level. Make sense? So if we look at LMT big picture, okay, we have our market structure change here. We went racing up like crazy. Clearly, this was smart money. What happens the first time we came to the smart money area? It bounced. Look where it bounced. It bounced right at that, very close, I should say, to the halfway mark that I had. Okay. But more recently, when I entered the trade here on 11/25, yes, it rejected the high of the order block. That's legitimate, but it also rejected my level. Isn't this amazing? That halfway point that I talked about months and months and months ago, here it went maybe under 30 cents, recovered. The day that I bought it, it went under about 30 cents, recovered. Okay, so one, it's important to find your order blocks, but two, it's important to find levels inside the order blocks. Again, it's finding an important level within an important level. And it's amazing how many times, even to the penny, it will get to that level that I mark. All right. So I entered here at 452.30 with the rejection of the midpoint in the order block. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this green line in the middle, 449.50. Okay. Place my trailing stop level how far above? 1.5 ATRs above. The next day, it went up, hit a profit target. Friday, it went up, but not enough for a profit target. See, the profit target's 395. It went up 370, so not quite there. So no profit targets, not a trailing stop level, but this particular trade not doing too bad, up 1.16%, and then I will get a dividend, it looks like, on Monday as well. Is that it? That's it. All right. So just as a recap, we have one that I got out of, but just as a recap, just to show you, USO remaining shares up 4.59%. Altria remaining shares up 4.05%. TMC remaining shares up 29.89%. Shopify remaining shares up 11.59%. FXY remaining shares up 1.02%. MasterCard remaining shares up 3.65%. Microsoft remaining shares up 4.13%. T-Mobile remaining shares up 1.03%. Lockheed Martin remaining shares up 1.16%. Okay, so I did have one trade that I got out of, and this is a very interesting trade, but I did get out. I'll explain to you why. But all in all, this was a massively good trade, right? I had to hit my stop on Friday, so you would think, oh, how is it a good trade? It is a good trade. Well, I'm going to show you the importance of taking partial profits when you have them. VIX. I entered VIX on 11/12/2025 at 32.89. Why? Rejection of the bottom of the order block. Clear, right? We went below it, closed in it. Placed my emergency stop 1.5 ATRs above. End of our stop, closed below the low of the order block, which we're very close to anyway. What happens? Next day, takes off like a rocket ship. Multiple profit targets. I'm selling into this strength. Now I'm in trailing stop mode. Next day, gaps open higher. I take off multiple profit targets on the gap up, reverses down, closes lower. Next day, up again, sold into the strength. Next day, up again, sold into the strength. Next day, down. Next day, up big reversal, sold multiple shares into that strength. Next day, up at the top, hit another profit target. Then here, the very next day, we have a first close below the previous bar's low after reaching trailing stop level. I sold half of the remaining shares that I had for a gain of 4.98%. And then after that, we just headed straight down, down, down. And then what happened here on Friday? It closed below the low of the order block. What did I need to do? I needed to get out of the remaining shares. And the remaining shares, I took a loss of 2.37%. But did I make money on this trade or did I lose 2.3%? 2.37%. Of course I made money on this trade because I sold and took the partial profits into this massive move. And then I sold here, first close below a previous bar's low after reaching trailing stop level. I took off, didn't have a lot of shares left when it was up here. And here I took off half of those. Okay. So yes, the remaining shares took a loss of 2.37%, but can you see how important? Imagine if you had not taken profits. If I had not taken profits, I'd have rode this up almost 20% and then rode it down for a loss of 2.3%. No bueno, right? No bueno. That's why, in my opinion, taking these partial profits is extremely important. Okay. All right. So those are all the daily positions opened and the close. I also trade weekly positions, everyone, based upon weekly bars, and I've only got 2 of those. Let's quickly do this, but it's all the same. Doesn't matter the time frame. This has been a fantastic trade. Now remember, each bar is a week. Okay. So I entered XLV on 8/8/2025 at $100. I'm sorry, 130.07. Okay, why? Well, I had been watching XLV for many weeks, and if you've been watching the podcast at that time, you heard me talk. I was like, XLV is getting down to an interesting area. It's getting down to a smart money area. And, and my favorite kind of trade is when you have a major moving average within an order block. Okay, you have a very important level within a very important level. Okay, but I did not take any action until here. Why here? Well, because this week, Friday, because weekly bars close on Friday, I entered at 130.07 because of two things. One, it bounced at the 300-week moving average. Two, it rejected the high of the order block. So I entered 130.07. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-week moving average, the orange line. Okay. Place my 1.5 ATR trailing stop level above, and away we go. Next week, boom, multiple profit targets. It's amazing how many times when you wait for these legitimate signals, as soon as you buy, they'll go your way. Not always, but more times than not. Okay. So next week, up big, multiple profit targets. Next week, up again, profit target, gotcha trailing stop level. Then we had 4 or 5 weeks sideways, didn't do anything. Then here on 9/26, we have our first close below previous bar's low after reaching trailing stop level. What do? I take off half. I took off half of my shares for a gain of 3.99%. But I kept half, thankfully. Next week, massive up, massive, multiple profit targets. Then we kind of danced around here for a month where we didn't do much. And then here we skyrocket up again, multiple profit targets next week, another profit target this week, another profit target. Now, this trade becomes extremely simple at this point. Remember when I said if you go up and reject the 70 RSI, then if it rejects the 70 RSI in the future, you sell half? Okay. Right now, we are at 71.22 on the RSI. So now it's very simple. Next week, if we go down and we close below 70, I'll just sell half of the remaining shares that I have. I don't have a lot of shares left, right, because of the scaling out. But next week, if we do close below the 70, I'll sell half. After that, if we have a close below previous bar's low after reaching the 70, I'll be done with the trade. Alternatively, remember, whenever you get to a 65 RSI level and then 65 or higher, okay, we're higher now, right? It's at least 65, it's higher. If we close below the 5 EMA, simply be out of the trade. So most likely, I would imagine the way that I will exit this trade completely is just simply a close below the 5 EMA. But either we reject the 70 RSI, sell half. After that, after rejecting the 70 RSI, if I have a close below previous bar's low, out of the trade. Or at any time here, a close below this 5 EMA, I'm out of the trade. So this has been a fantastic trade. This particular trade, the remaining shares up 17.56%. All right, last one, thank goodness. UUP, which is the dollar. This is a weekly trade. I entered here on the 11th of July, so 7/11. Why? Two primary signals. Order block, we were in it, we closed back above it. That is a rejection of the top of the order block. We also rejected the 200-week moving average. This is the black line here, okay? So I entered based upon those two signals at 27.21. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. That's it. Place my 1.5 ATR trailing stop level above, and away we go. Next week, up, profit target. Next week, down, no profit targets. Next week, up, biggies, multiple profit targets, and I'm also in trailing stop mode. Next week, down. Next week, down. First close below previous bar's low after reaching trailing stop level. What do? That's right. I take off half for a gain of 1.54%. Then we move sideways for about a month. On this week, we were well below. I thought I was going to have to get out of the trade, but miraculously, it closed back above, kept me in the trade. Next week up, profit target. Next week, nothing. Next week up, profit target. Couple weeks, nothing. Next week up, profit targets. Okay. And right now we are hovering at 58.11. If I get to 65, then the 5 EMA comes into play. As long as it stays, or if it goes down, I will just stay in unless it closes below the 200-week moving average. And so the remaining shares that I have on UUP up 3.54%. So that's it. Those are the daily trades, the open daily trades, the closed daily trades, and the open weekly trades. So you can see had some really great results with a very simple strategy of being patient and waiting for those confluence of signals, like the rejection at the top of the order block, the bottom of the order block, some midpoint or some level in some important level inside the order block, or rejection of a major moving average. This is what I do, folks. This is how I trade. This is how I structure all my trades. And you should really learn how to do this. I know it will improve your trading. So, okay, before we go on to the potential trades for next week, let's talk a little bit about trader psychology first, okay? Okay, this week's post comes from Steve Burns, as it usually does. Steve always writes such good posts on X. Please follow him at @SJosephBurns on Twitter. Steve is a friend of mine, a trading mentor and a coach to me. Many years ago, I've learned so much from Steve, and he's such a great author. He sells writes so many great books. You can find him on Amazon. Moving Averages 101 is probably my favorite. I was lucky enough to write the foreword to that book. So please go and check out his books. You will learn a lot. So let's see what Steve has to say today. So acknowledge that good systems have losses and bad systems have wins. Short-term results can't validate your edge. This will keep you from overthinking each trade if you think long term. And, as traders, we need to think long term, kind of like long term investors. It's just that we're long term traders. There's a difference, but there's some similarities as well. So, the best systems, right? I feel like I use some of the best systems: order blocks, major moving averages, the combination of the two. They don't always work, but they work more over the long run. They work very well, but not each trade. Each trade by each trade can be a win, can be a loss, can be a win, can be a loss. That's fine. But what a lot of people do is they look at the last trade. This order block didn't work. Order blocks don't work. Okay, that's totally false, but this is how people think. If they take a bad trade and it works, they're chasing something up high and it goes higher. Oh, yeah, see, this works really well. Yeah, it worked really well on that trade. But if you took that trade 1,000 times, you would net lose money. If you took the order block trade 1,000 times, you would net win money. So that's called recency bias. And a lot of people fall into recency bias. If this one particular setup works, oh yeah, this thing works great all the time. I love when people use the words all the time, has to, always. If you are speaking to people and they're using the words always, has to, they're amateur traders. I promise you, because professional traders realize there is no such thing as always, right? Like I get this all the time from people. Whenever I hear it, it's like somebody scratching a chalkboard. Okay. So acknowledge that good systems have losses. Yes, trade by trade, they can have losses, 100%. But it doesn't mean you shouldn't use them, because in the long run, they have the edge and the math works out. Bad systems certainly have wins, but does it mean you should keep using them if you had a win? No, because in the long run, you're going to lose. Have you ever gone to Las Vegas and won a hand of blackjack? I'm sure you have. Have you ever played roulette and hit black or red and won? Absolutely you did. Does that mean it was a good bet? Absolutely not. You know in the long run in Las Vegas you're going to lose, because the house has the advantage on the games. Well, it's the same with trading, but you are the casino in the market. You have an approach that over time you have the win. You know, do you think if the Mirage, they lost 10 hands of blackjack to someone, they're like, oh, that's it, we're done. We're done. This doesn't work anymore. Of course not. It's the same with trading. So don't have recency bias where if you use a legitimate trading approach and it doesn't work for once or two or three times, don't abandon it. If it's a good, back tested, legitimate system in the long run, you'll get the money. The math will work out. So think about that, okay? If you have a good trading approach, whether you learn it from me or someone else, stick with it, because if it is good, long term, good risk to reward, multiple confluences, in the long run, the math will work out. So let's read it one more time. Acknowledge that good systems have losses and bad systems have wins. Short term results can't validate your edge. This will keep you from overthinking each trade if you think in the long term. Probably what I would put in here, short-term results can't validate your edge. That edge will only show itself and manifest itself in the long run. Just like hitting a baseball. You can have a horrible swing and hit a good hit. Does that mean it was a good swing? No. Over time, are you going to hit any home runs or do well in that game with that swing? No. Can you have a really good swing where you miss the ball? Sure. Does that mean you should give up that good swing? No. Because in the long term, a good swing is going to get you good results. It's all the same, everybody. So thank you, Steve. Please keep that in mind. Please follow Steve at @SJosephBurns on Twitter, or X, I guess they call it, right? Okay, let's go to the potential trades that I have for next week. Now, I have 7 of them here that I'm going to go over with you. It is possible next week that all 7 of these could trigger on the same day. So does that mean I'm going to take all 7 trades? No. I have a hard and fast rule where I only take one trade per day. I don't care if I have 10 legitimate ones, I'm going to narrow it down to the best one. How do I do that? Well, I give each legitimate trade a score. Like, for example, if I had 1 entry signal, I'd give it a score of 1. If I have 2 entry signals, I'd give it a score of 2, right? If I had something that rejected the order block and that's it, 1. If I have something that rejected the order block and rejected a 200-day moving average, 2. Which one am I going to take? I'm going to take number 2. I'm going to take the one with 2, obviously, right? Now, there's some other factors. This is what I teach my students in my course too. Maybe we have a double bottom bullish MACD divergence. Okay, that's going to get extra points. Maybe we have an RSI divergence. That's going to get extra points. I'm going to look at the longer term time frame. If I'm trading the daily, I like to look at the weekly. Is there something on the weekly that is also showing me there's some kind of valid signal on the weekly? Yes, that adds extra points. I have to take into consideration, maybe I have something that has 4 entry signals, but it's zoomed up so far that the risk to reward ratio isn't good. I have to factor that in too, right? It's the nuances, right? And so this is what I teach my students, how to do this. And I do teach a 20-hour one-on-one course. I think the best way to learn anything, everyone, is one-on-one with your teacher or your coach. And that's why I structure this. It's 2 hours a week for 10 weeks. I've been trading for over 30 years. I have taught people from absolute beginners all the way up to the hedge fund level. I consult with hedge funds on a monthly basis. Even now, teaching them the exact same thing that I'm teaching you. So if you'd like to become a student of mine, it's an intense course. I teach you all the different trading approaches that I use. I teach you all the rules. We do a lot of simulation trading. I throw a lot of curveballs at you each lesson. Make sure you're listening and that you fully understand, because it's very important to me that my students succeed in trading. And just my most recent students been doing very well. Very proud of them. I feel very proud when I see them with their trades and what they're doing, and I'd be happy to do the same for you. So if you would like me to become your teacher and coach and teach you everything I know, I'd be glad to do it. I'll bring 110%. And really all you need to do is send me an email. The email is in the link of this description. If you do send me an email, we'll have just a free Zoom, or not Zoom call, Teams call. It's not a sales call. I'm not trying to sell you on anything. I just want to learn more about you, your trading, your challenges, your goals. It's a good time for you to ask me questions about the format of the course. And then at the end of the call, if we decide, we're a good fit and move forward, we will. And if not, well, then it was great to know you. All right. So it does cost $2,000. It's, it's a lot of money, but it's an investment in yourself and a skill that you can use for the rest of your life. And I promise you it's worth every penny. And I promise you, you're going to be glad you took the course. Now, as an alternative, I do have a really good video course, online video course at udemy.com, where I teach you the deep dip buy stock trading strategy. This is the 250, 250, 300-day moving average RSI. I have not yet made an order block course for Udemy, although I am planning on doing that next year. But obviously the 20-hour one-on-one, you learn everything. But if you're not in the financial position to do that, starting with the deep dip buy course on Udemy, it's between $30 and $50. That's a really good place to start as well, and that link's in the description. So, okay, so that takes care of the business end of everything, and let's start and take a look at what I'm looking at next week on AMD. Okay, AMD, we just formed an order block. It's a new order block, just recently born on Friday. Why? Well, remember, we need a swing low. Here's a swing low. We need a swing high. Here's a swing high. Now we need a lower swing low. This is lower than this swing low. And then we need to go, so swing low, swing high, lower swing low, and then we need to go above the swing high. Boom, that happened on Friday. See it? Now, am I buying this breakout? No. I mean, nothing wrong with it if that's what you do. But now that it has changed market structure to the upside, my lowest closing bar before market structure change was here. This is my new order block. I've defined the order block, the high and the low. Boom, bring it into the future. Now you can see that I drew a green line in here. Why? Well, it's back to what I told you. If you have a big up bar, a nice big up bar like we did here on the 25th, halfway of that big up bar, there will be some inherent Fibonacci support at that 50% level. Okay, so here now is my line in the sand. I have an important level halfway of the up bar inside an important level inside the order block. Now, if we rejected the high of the order block, could I take that trade? I could. I probably wouldn't. What I'm really looking for is a rejection of this order block. I'm sorry, this line in the order block 199.60. So if it moves down, rejects this level, closes above, that would very likely be my entry point. Or as always, and kind of goes without saying, if it heads back down, rejects the bottom of the order block and closes back in the order block, I could also take the entry there as well. DIA, which is the Dow Jones. Okay, well, you see a block here, but this one's red. Well, I always talk about bullish order blocks, which are green, but this is a bearish order block, everybody. And a bearish order block is the exact opposite rules. Instead of a low, instead of a swing low followed by a swing high followed by a lower swing low and then market structure change, this is the opposite. We have a swing high followed by a swing low followed by a higher swing high followed by market structure change to the downside. And once you market structure change to the downside, the highest up bar close prior to market change to the downside is your bearish order block. Okay, think about it in the past. Was smart money buying here? Not really. Quite the opposite. If you bought here and then you went through this, it was not smart money. This is more of unintelligent money up here. So if we come back to unintelligible money area, what do you think I'm doing? I'm looking for a short, right? Well, we're getting pretty close. So potentially for me to get short here, the orthodox rules are if you reject the bottom of the order block, that could be a short with a close above the high of the order block. Me personally, I probably would wait for a rejection of the high of this order block here at 484.39. Now, if I get a V1, a bearish V1, or a bearish V2 inside the order block, I could consider that as well. But kind of big picture here, if you are long, if I was long the Dow, personally, I'd probably be looking to exit in this area, right? Because I know it's an order block. Now, it can blast through there. It totally can, which would negate the signal. But right now, really what I'm looking for is a rejection of the high of this order block to get short. The high of the order block is 484.39. I would position size, place my emergency stop 2 ATRs above, and my stop would simply be a close above this order block. That would be it. So I am looking for a potential short here on the Dow, DIA. Meta. Okay, Meta is really interesting here. We have changed market structure. Let me show you why. Swing low, followed by a swing high, followed by a lower swing low. And then here, we took out this swing high. So here on the 25th, we changed market structure to the upside. As soon as you change market structure to the upside, now you know where your order block is. It's the lowest closing bar prior to market structure change. Bring that into the future. Here's your order block. Remember, after market structure change, I want to buy a pullback to this area. Now, I've put a line in here at 595.30. What's that line? This is an important line. This is the top of the baby. Now, you've heard me talk about bullish abandoned babies. What is a bullish abandoned baby? A bullish abandoned baby is when you gap down, like we did, and then the very next day we gap up. When you gap down, gap up, generally in the future, you're going to be higher. Was it correct? Yeah, totally. But the key point of why I drew this line here at 595.30 is the top of the baby is an important support level. So that is why I drew the 595.30 line here inside. 595.30 is I am waiting on Meta, if we do get a pullback, a back test at this 595.30 level. And if it does that, closes above, I would certainly consider taking that entry. Where would my close be? Close below it. Alternatively, if we come down, go through it, but reject the bottom of the order block, certainly I would consider taking that as well. NVIDIA. All right, NVIDIA is interesting, folks. Obviously NVIDIA has been this huge high flyer, but over the last few weeks, it has just gone down. So, is there opportunity here? Sure. Absolutely, there's some opportunity here. And what I'm looking at is this order block. Okay. So, and very often times when you're looking for bottoms, the bottoms are identified by the order blocks. But let's take a look and see why this is an order block. Swing low, swing high, lower swing low, market structure change, lowest closing bar prior to market structure change. Boom. People buying here, you look in the future, were these, when the market was up this high and you look back here, was smart money buying? Sure, obviously it was. So we are getting close to that level. So we have this up bar here, halfway of the up bar is 166.60. That's why I have placed it inside the order block. Again, an important level with an inside an important level. In addition to that, megaphone trend line. You take a swing low, connect it to another swing low in the future, draw that line out. If in the future you make a third point to that trend line, very often you have a bounce. Okay. Well, this is all combining here, lining up here in this level. You have the 166.60 level, which is important. inside the order block, which is important. And you have the destination, depending on how long it takes, you have the destination of a third point of a megaphone trend line. So this intersection here is perfect. The megaphone trend line intersecting the important level of 166.60 inside the bullish order block. So that's really what I'm looking for. Look, a rejection of the top of the order block, I would consider it because the order block's not too high. Ideally, I would love the rejection of 166.60 because of all the confluences that I just told you about. And then, of course, if we get a rejection at the bottom of the order block, that would also be legitimate as well. So I don't know if we're going to get here. We may just take off and go up from here. I'll miss it. It's fine. But if it does, I'd be very interested in NVDA basically in this 166, 167 level, 10 points below us. TLT bonds. Okay, bonds just created a new bullish baby, order block. Why? Swing low, swing high, lower swing low, market structure change, defines the order block, lowest closing bar before market structure change, bring that on into the future. This is not a tall order block, so a rejection of the high of the order block at 89.33 I would consider. Rejection of the low of the order block, 88.84, I would also consider. Also a 200-day moving average down here. If we lose the order block, I could also key off of this level as well. But, bonds have been quite strong. We've had a little bit of a pullback, but I'm just waiting for a pullback into the smart money area or the order block area. VIX. Okay, so I exited VIX on Friday with the close underneath the order block. However, this is very important, everybody. This level on VIX has been extremely important. We came to this order block level. We created an order block. It held. VIX took off really, really hard and fast to the upside. What did the market do? Of course, the market went down. Then the market went up and VIX came down. But as soon as we got back down to this order block area, what did the market do? Well, VIX went up and therefore the market went down. And then the market went up and so it drove VIX down. And then when it got back to this order block area, what happened? The market went down like crazy. VIX went up like crazy. Now the market's gone up like crazy. VIX has come down like crazy. So what am I looking for? Well, two things I want to point out here. This is kind of a key level. Obviously, every time we've kind of gotten to this level, that's been the market top. So that's one point. I would not be surprised to see the market reverse here because of this level. But from a trading standpoint on VIX, if we close back up into the order block, even though I got out of it, I would consider entering the VIX trade again. But Friday, we closed under it, so I got out. Monday, we closed back in it. Depending how we close in it, I would consider getting back in, okay? And then last but not least, XLF. All right, XLF, I've been talking about XLF here in the bullish order block in the green. And what I liked about it, I liked the 200-day moving average inside of the order block. Well, this would have been a legitimate entry. You would have had to get out here the next day. Next day would have been another entry, and it took right on off. So you can see getting into that order block is right, almost exactly called the bottom, which it did. However, the flip side of that is we are now in a bearish order block. Why? Swing high, swing low, higher swing high, market structure change. Was this smart money last time? No, it was not. People that bought here got hurt. So now we're coming back into that same level. Does it have to stay the same? That it's going to come down from here? No, it could go ripping up higher for sure. But from an odds perspective, we are in a bearish order block, okay? So this is a megaphone the other way. We have a swing low followed by a higher swing low. And when you connect those and run that out into the distance, if we touch that line very often, there will be a reaction there and a pullback. Well, this trend line, you can see we were above this trend line acting as support, and then we broke it to the downside. Now it's acting as resistance. So if we're coming back into this trend line, just by itself, there's going to be some kind of resistance there. But again, it's going to be resistance inside the bearish order block. So it's an important level with inside an important level. So just to kind of clean this up a little bit, I am looking for a rejection of this trend line, meaning it goes above it during the day, closes under. I would consider a short there. And or if we reject the high of the order block here at 53.88. So you can see this week I have added a few potential short positions as well. So I know we've been through a lot. I hope this helped everyone. If it was, I'd appreciate if you could hit the thumbs up. If you have any comments or questions about whatever I mentioned in the podcast today, please put them in the comment section. I'll do my best to get back to you and answer them. But listen, I hope you have a good rest of your weekend. I appreciate if you made it all the way through. I hope you've learned something. I always like to leave off with, if you could please try to go out and do something nice for another human being each day, really would make the world just a better place if we could all do one nice thing for each other, wouldn't it? I mean, obviously it would. If you could go out, try to do one nice act of kindness for an animal each day, that would be even better. Why not do both, right? What's it going to hurt? It would just make the world a better place. So I hope you have a good rest of your weekend, everybody. I hope you have a good trading week next week. If I can be assistance of you, please let me know. Love to be your coach. Love to take you through the 20-hour course. I do private consulting also for financial companies and larger term traders and smaller term traders too. So if I can help you anyway, I'm available. Please let me know. So thank you so much, everybody. And God willing, I will see you next week. Take care.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.